In this presentation, we will continue on with part 2 of our example problem related to a hospital. We'll be continuing recording transactions related to the hospital. We're going to have the information is going to be up on the left. We're going to be journalizing the journal entry down below and then posting that journal entry to our trial balance worksheet on the right. Trial balance worksheet is going to be in order with the green accounts being the asset accounts, the orange accounts being the liability accounts, the light blue account being what would be the equity section in a for-profit type of organization, they being here the net assets section, and then the dark blue accounts being what would be the income statement accounts, the revenue and expense type of accounts in a for-profit type of organization, here being those temporary accounts as well, those accounts that would close into the equity section in a for-profit organization, here closing out to the net assets section. Debits will be positive, credits will be negative, so that the zero will show that the debits equal the credits. The bottom line number will be the net income down below. This net income is, or equivalent to net income, is going to be the revenue type accounts minus the expense type of accounts. Note we are at a loss at this point in time, meaning the expenses are greater than the revenue. Here's our transaction, or our activity. Collection on account of the 1,174,000 accounts that became uncollectible are going to be 13,300. We will be recording these transactions as if we're recording a lump sum of all the similar transactions during the time period. So obviously whenever someone pays us on account, we would basically have this type of transaction collecting the cash and decreasing the accounts receivable, where we're going to record all those transactions as if they're basically one lump sum transaction throughout the time period. So if we had collections on account, that means that we got cash. Cash would then be increasing. Cash is a debit balance. It's going to go up in the debit direction. And then we're going to be crediting the accounts receivable. So in other words, we already recorded the revenue in the past when we, in essence, billed the client, we could think of, and that increased the receivable and increased the revenue. Now we're talking about the transactions related to the collection on account, simply increasing one asset account, the cash, decreasing the other asset account, the accounts receivable. So the accounts receivable then going down in the credit direction. Next, and we're going to include this in the same transaction, we have the accounts that became uncollectible. Now, the accounts that became uncollectible means that we got to decrease the accounts receivable because those accounts are no longer collectible. Instead of recording basically a decrease to basically the revenue account or bad debt expense, as we might do in a direct write-off method, we're going to be decreasing the allowance account for those items. So the accounts receivable is going to be going down by that 13,300 because we know exactly who's not going to pay us, and then we're going to be decreasing the allowance. Now, if you have questions or confusions about this allowance method, we have a course on accounts receivable and the allowance method versus the direct write-off method, and you could take a look at those for more details with the allowance method. It'll be very similar for a for-profit and a hospital. Recording this out then, we're going to record the journal entry. The cash is here. Cash is going to be on the debit side, so here's the debit to cash. We're going to be increasing it in the debit direction. Here's the ending balance. The allowance for uncollectible accounts is here. That has a credit balance in it. We're going to be debiting the allowance, making the contra asset go down, and then the other side of that would be going into the accounts receivable. The accounts receivable then has an decrease. We had the 900,000. We're going to be decreasing it because it's going to be going down both by the amounts that we got paid as well as by the amounts that we determined we're not going to be paid for. So we're going to be decreasing the accounts receivable, and note that the accounts receivable currently has a negative balance, a credit balance in it. Don't let that throw you off. That typically wouldn't be the case. Something's kind of funny there if we have a credit balance in the accounts receivable. So don't let that throw you off. Note that there's no effect down here on the income statement accounts, no effect on what would be kind of like the net income type number. Next transaction, cash payments of vouchers payable paid to employers and suppliers. So now we're going to be recording the cash type of transaction related to the purchasing side of things. You'll recall that we recorded a lot of transactions recording to the increase in the vouchers payable, things that we in essence purchased on account, increasing the vouchers payable. Now we're going to be decreasing it by paying it off. This would be the second type of the transaction related to the flow of a vouchers payable type of system. Note, once again, we're going to be paying it all off in one lump sum type of transaction. Obviously, in practice, we would have a bunch of payments that would be happening as we go through the period. We're going to be grouping them together here to record these type of transaction in one journal entry. So we're going to then be having the vouchers payable is going to be debited. You'll note that it has a credit balance account. Therefore, we will debit it to make it go down. The other side then going to cash. Cash has a debit balance. We will be crediting it to make it go down. Recording this, then we have the vouchers payable. The vouchers payable has a debit balance or a debit that we will be doing to it. It has a credit balance in it. We will be debiting it to make it go down. Here's the new balance. Then we have the cash. Cash has a debit balance in it. We will be crediting it, making it go down. Note that there's no effect on the net income type number here as well. We recorded the expenses when we recorded and increased the vouchers payable, which is similar to the accounts payable. Next transaction, supplies issued to nursing services. So now we're going to record the supplies that are going to be issued. In other words, the inventory up top is going to be supplies inventory. We currently have the 108,978. We're going to have to be tracking that supplies inventory and issuing it as it goes out into use. When that happens, we're going to record the transaction to record the issuance of the supplies. So that's going to be a debit to the nursing service expenses that are going to be consumed and a credit to the inventory then decreasing. If we record this out, then we're going to have the supplies at the 108,978. We will then be crediting the supplies. That's going to be this one, bringing it down to 7,808. Then we have the nursing service expenses. It has a debit balance. We will be debiting it, and that will be increasing it in the debit direction. That would bring down what would be the net income type number. However, here we have a loss. So it started at the 210.40, and then it went down further in the hole to the loss of 311,210. Next transaction, accrued interest income on investments at year end. So we're going to say that there's interest income. We have investments, of course. The investments are gathering or accruing income. We could call it interest income. And as of the end of the year, we have an adjusting entry where we have not yet received it, but we have earned it. Therefore, we have the adjusting entry to increase the accrued interest receivable, a receivable account for what is owed to us on the investment for which we have not yet received. And then the credit is going to be increasing the investment income, a type of income like interest income, investment income. Recording this out, then we have the accrued interest receivable. It's a debit balance account. It's going up in the debit direction. Then we have the investment income. Investment income is an income account. It's going to be going up in the credit direction. And here's the ending balance in the income account. That would be increasing, of course, the net income. So we have a loss of the 311,210. We're going to be increasing, in other words, going closer back up to zero, which would be a credit balance, would be a gain. And then that'll give us the 308,910, less of a loss at this point in time. Next, we're going to be recording the depreciation on building and equipment. So this is going to be an adjusting type of entry, one we would do at the end of the time period. You'll recall it's going to be very similar to a for-profit type of organization. We have the building here. We have the equipment. When we put the building and equipment on the books, we don't expense them at the point of purchase because they're going to be long-lived assets that will be benefiting into the future. Therefore, we put them on the books as an asset, and then we are going to allocate the cost of those items to the time period in which they are used with the use of depreciation expense and accumulated depreciation. If you want more information on the building expense and depreciation and equipment, then we have a course on that. You can take a look at that. We go into much more detail in that. So we're going to record then the debit to depreciation expense. That's at the 154,000 depreciation expense. And then the credit to accumulated depreciation for the building and the equipment respectively. If we record that out then, we're going to see that the depreciation expense is going to go up, allocating the cost to the time period that it's going to be used in accordance with the matching or expense recognition principle, that then decreasing what would be like the net income, in this case taking us further into a loss. The accumulated depreciation then is going to be going up in the credit direction. So accumulated depreciation increasing in the credit direction. It's a contra asset account. As it increases, it will then decrease the book value of the building and the equipment. So the credit side is going up, book value then going down.